Fundamental analysis measures a security intrinsic value by examining related economic and financial factors. Intrinsic value is the value of investment based on the issuing company's financial situation and current market and economic conditions. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions to microeconomic factors like effectiveness of a company management, etc. Once a trader has determined the security's intrinsic value and consider other key indicators such as market sentiment, we can use that information to inform their trading decisions. But we are not going into such crazy details with fundamental analysis. There is no reason to overpress your mind with unnecessary things at the beginning. But there are some things that you must watch all the times, in order to not be swiped out from your positions. First one, key times. Key times is any economical, political, governmental, or market event which usually has big influence on market and affect its prices. All the key times must be on your radar and make sure to not trade in those periods, at least few minutes. Do not take any trading decisions during key times, at least couple of minutes. And if you have some open positions, better close them before those times. You don't want to take extra risk. Your position could be swiped out so quickly at those periods. Also, your position could jump to take profit right away. But this is not what is trading all about. It is not a casino. First, market session times. A trading session is a period from market opening time until market closing time, based on asset class and country. The regular trading session for United States stocks starts at 9:30 a.m. and ends at 4:00 p.m. Eastern Time on weekdays, holidays accepted. These times are primarily driven by the working hours of the New York Stock Exchange. Europe has two main opening times, London and Continental Europe, such as Euronext Amsterdam, Frankfurt Stock Exchange. London Stock Exchange opens at 08:00 a.m. GMT time and closes at 4:30 p.m. same time. Continental Europe opens at 09:00 a.m. Central European time and closes at 05:30 p.m. same time. If you are trading in Asia, you also should mark Asian market opening time. Usually, first 3-4 hours after market opening time are the most important, with greatest volatility, in which you should look for an entry into the market if opportunity presents itself. It doesn't mean that you cannot trade after or before market opening time. You still can make trading decisions before and after. Just keep in mind that best volatility and greatest trading opportunities comes at market working time. So recommendations would be to take trading decisions at market working time. Some markets may have pre-market or after hours trading sessions. These times are less powerful but still important to know. Pre-market trading for United States stocks occurs between 4 a.m. and 9:30 a.m. Eastern Time on weekdays. After hours trading, on the other hand, is from 4 p.m. to 8 p.m. Eastern Time on weekdays, although these times may vary slightly by exchange. Europe pre-market opens at 8 a.m. Central European Time on weekdays. There are a few negative factors to trade before and after market working hours. You might receive false signals, low volatility, lack of liquidity, larger quote spreads, uncertain prices, because there are less trading activity, so be careful. There are some markets with 24 hours trading session. Among the most notable ones are Forex and crypto. Despite that those markets have no opening time, European and especially United States market opening times should be marked anyways, and avoid to make trading decisions. Reason is simple. A lot of volatility and buying or selling pressure comes into the market, and usually has effect on most financial assets. Economic events. Then follows economic events, like interest rate decisions, GDP release, inflation data, and many more. Economic events always have impact on markets. Therefore, you have to follow the biggest ones. Main economic events can be divided into several categories. inflation events, and gross domestic product, GDP. GDP release, CPI, consumer price index, PPI, producer price index, central bank events, monetary policy reports, any other report by central bank, Fed in USA, press conferences, speeches, interest rate decisions, consumers, retail sales, the index of consumer sentiment, the index of consumer expectations, labor market, unemployment rate, initial jobless claims, housing market, building permits, energy market, crude oil inventories. These are main economic events which you should keep eye on and avoid to make trading decisions. I will not get into details of each event because it would take too much time and are not that important since we will not make trading decisions based on those events. All you need to know for now is avoid to make trading decisions during releases of those events. Where to find most of key times? For your news portals, and there are quite a few good of them, like Yahoo Finance, Investing.com, Simple Wall Street, and etc. Some of them has really good economic calendars, which is easy to use. For example, Investing.com, we have comfortable economic calendar. Choose your time, and you will see economic event releases on your time. In this way, you can mark main ones to keep in mind later on. They have impact indication. 3 stars means that this event might have bigger influence on financial assets. So it is really simple and easy to follow. Of course, you can and you should choose the news portal whichever you want, whichever is comfortable to you. Important is to follow these events and not to trade during those. Recommendation would be to mark the biggest ones and not to pay attention to others. Through experience, you will learn the most key times and be able to analyze and interpret them correctly. Every trader looks at these events. For example, United States is expecting to increase interest rate, and if it happens, market will probably have a rapid move down. Or an example is predicted nice increase of GDP, which is really positive, and you can expect for market to move up. And at this moment, make sure to follow key times and do not trade during those. Another topic shortly to cover is news. News can be classified as unexpected or recurring news. Unexpected news, an announcement of sudden or unforeseen occurrence, such as natural disaster, an economic or financial development, or a terrorist attack. Recurring news, an announcement that occurs at the same time after a steady period of intervals. For example, a quarterly reports, economic statistic releases, or interest rate announcements. Now we are interested in unexpected news. You have to keep eye on news portals. It doesn't mean that you have to look each 10 minutes there. At least once or twice a day it is recommended to check that there is nothing bad happening. Unexpected news always have negative influence on markets, especially if it is a global thing. People react to those news. That's why it has effects on markets as well, no matter what. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.